Welcome back to the Community Corner podcast, where we explore the companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're focusing on Goldman Sachs Group, Inc., one of the most prestigious investment banking, securities, and investment management firms in the world. We'll be discussing how behavioral finance impacts their decision-making, diversity and inclusion efforts, adaptation to different markets, and how they compare to other companies in the industry. Let's get started.
Goldman Sachs has a storied history in the financial services industry, but from a behavioral finance perspective, how do biases like overconfidence and the herding effect influence their decision-making, especially in areas like investment strategies and market positioning?
Overconfidence is a particularly relevant bias for Goldman Sachs, given its reputation for expertise in investment banking and asset management. The firm's track record of successful deals and market predictions can foster a strong belief in its ability to continue outperforming the market. This overconfidence can lead to aggressive investment strategies, bold market positioning, and significant risk-taking, all underpinned by the firm's belief in its analytical prowess and market insight. While this confidence has driven many of Goldman Sachs' successes, it also exposes the firm to significant risks, particularly in volatile or uncertain market conditions. The herding effect is also important, especially in how Goldman Sachs navigates financial markets. In the world of high finance, there is often a tendency for firms to follow the actions of other market leaders, either to capitalize on perceived trends or to avoid the reputational risks of being contrarian. Goldman Sachs, while often a market leader, is not immune to the pressures of herding behavior. This can manifest in the firm's strategies around asset allocation, investment banking, and trading, where following the broader market can sometimes mitigate risks but also limit the firm's potential to capitalize on unique opportunities.
And this combination of overconfidence and strategic alignment with market trends has helped Goldman Sachs maintain its leadership position in the financial services industry, appealing to both clients and investors who value expertise and bold decision-making.
Exactly. Goldman Sachs' strategic use of overconfidence in driving aggressive market strategies and the herding effect in aligning with broader market trends appeals to investors looking for a company that is not afraid to take calculated risks in pursuit of high returns. However, this approach also means that Goldman Sachs must carefully manage the risks associated with market volatility and ensure that its confidence does not lead to overexposure in uncertain environments.
Let's talk about diversity, equity, and inclusion at Goldman Sachs. As a major player in global finance, DEI is particularly important for Goldman Sachs. How does this intersect with behavioral finance?
Goldman Sachs' approach to DEI is crucial, especially as the company operates in a global and highly interconnected industry where diverse perspectives can drive better decision-making and innovation. From a behavioral finance perspective, strong DEI initiatives can enhance Goldman Sachs' ability to innovate and adapt by fostering a culture that values diversity and inclusion. A commitment to DEI allows Goldman Sachs to attract and retain top talent from various backgrounds, which is essential for maintaining its competitive edge in investment banking and financial services. For investors, Goldman Sachs' focus on DEI can signal that the company is socially responsible and aligned with modern societal values, which can enhance its reputation and appeal to ESG-focused investors. Additionally, DEI efforts can help Goldman Sachs build stronger relationships with clients, regulators, and communities, which is vital for navigating the complex regulatory and social environments in which it operates.
Investors are increasingly considering DEI when evaluating companies, especially in finance, where the ability to innovate and serve diverse clients is critical to long-term success.
That's right. By embedding DEI into their corporate culture and investment strategies, Goldman Sachs not only improves its ability to serve a broad range of clients but also strengthens its market position and attractiveness to socially conscious investors.
Moving on to global markets, Goldman Sachs operates in numerous countries, providing investment banking, securities, and investment management services to clients worldwide. How does the company adapt to different markets, and what role does behavioral finance play in this?
Goldman Sachs's global strategy involves tailoring its financial services to meet the specific needs and regulatory requirements of different regions while maintaining its core focus on providing high-level expertise and strategic advice. From a behavioral finance perspective, this adaptability is crucial for managing the risks associated with operating in diverse markets. Goldman Sachs's ability to navigate complex international regulations such as those related to banking, securities, and investment management allows it to maintain a strong global presence. The company's approach to understanding local market dynamics and adapting its strategies accordingly helps mitigate risks associated with geopolitical instability, regulatory changes, and economic fluctuations. By ensuring that its services are relevant and compliant in different regions, Goldman Sachs can continue to expand its market share and strengthen its global brand.
And this adaptability is essential for Goldman Sachs, especially as they face competition from both local financial institutions and other global giants. Their ability to maintain their brand's relevance and leadership in different markets is key to their continued success.
Exactly. Goldman Sachs's focus on understanding local market dynamics and adapting its strategies accordingly allows them to remain a dominant player in the financial services industry while staying ahead of emerging trends and challenges. However, this also requires them to be proactive in responding to changes in global financial regulations, economic environments, and competitive pressures.
Now, let's compare Goldman Sachs to other companies in the investment banking and financial services industries like JP Morgan Chase, Morgan Stanley, and Citigroup. How do the behavioral finance dynamics differ?
Goldman Sachs's dynamics are often compared to other financial services giants like JP Morgan Chase, Morgan Stanley, and Citigroup, particularly in their approach to investment banking, asset management, and market competition. Goldman Sachs's strength lies in its focus on high-level investment banking and asset management services, which appeals to investors looking for a company that prioritizes expertise and strategic advice. JP Morgan Chase, with its diversified business model across consumer banking, investment banking, and asset management, appeals to investors interested in a company that balances stability with growth opportunities. Morgan Stanley, known for its strength in wealth management and institutional securities, attracts those looking for a company that is heavily invested in financial advisory and capital markets. Citigroup, with its global presence and focus on consumer banking, appeals to investors interested in a company that combines global reach with a broad range of financial services. Goldman Sachs's behavioral finance dynamics are shaped by its reputation for expertise, strong client relationships, and global adaptability, making it an attractive option for those seeking stability and growth in the financial services industry.
And unlike JP Morgan Chase, which has a broader focus across multiple financial services, Goldman Sachs's strength lies in its specialization in investment banking and asset management, appealing to a different type of investor and market.
Absolutely. Each of these companies has its own behavioral finance dynamics that influence how investors perceive their value and potential risks. For Goldman Sachs, the focus on investment banking, asset management, and global reach provides a unique value proposition in the financial services industry.
To sum up, Goldman Sachs's approach to business is deeply influenced by behavioral finance principles, whether it's through their investment strategies, global market adaptations, or their approach to DEI. But like all companies, they are still subject to the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics provides a clearer picture of what drives Goldman Sachs's stock price and where the potential risks and rewards lie.
Thanks for joining us on this episode of the Community Corner podcast. Until next time, I'm Arnav.
And I'm Nikhil. Stay curious and keep questioning the narratives.